Hello everyone and welcome to today's video on how to make informed investment decisions in the stock market. Today, investing money in the stock market has become incredibly complex, causing confusion and uncertainty for many individuals. In this video, we'll discuss what to consider before investing in the stock market to ensure a profitable long-term investment. Company promoter. One of the most important things to consider before investing in the stock market is the company promoter. A company promoter is an individual or a group of individuals who are responsible for promoting and establishing a new company. They play a crucial role in the formation and early stages of a company's development. The promoter is responsible for raising capital, acquiring assets, and establishing the initial operations of the company. In the context of investing, a company promoter refers to the individuals who own and manage the company. Knowing the background and experience of the promoter can give insight into the company's leadership and future plans. This information can help an investor determine the risk involved in investing in the company and make informed investment decisions. It's important to research the promoter of a company before investing, as their reputation and track record can have a significant impact on the success of the company and the return on investment. A strong and experienced promoter can increase the chances of success for a new company, while a promoter with a negative reputation may increase the risk of failure. When researching a potential investment, it's crucial to understand who the promoter of the company is and what their share in the company is. This information can give you insight into the team behind the company and help you determine if your investment is at risk. Volatility. Another important factor to consider is the volatility of the company's stock price. Volatility refers to the fluctuation in the price of an asset, such as a stock, over a certain period of time. It measures the degree of price variation over a specific time frame and is a common indicator of risk in the financial market. Higher volatility means that the price of an asset can change rapidly and dramatically over a short period of time, which can make it more risky for investors. In the stock market, volatility is used as a measure of risk for individual stocks, as well as for the market as a whole. A company with a high degree of volatility in its stock price may be considered a riskier investment than a company with a lower degree of volatility. This is because investors may have to weather larger and more frequent price swings in order to hold the stock, which could lead to losses. Volatility is a crucial factor to consider when making investment decisions, as it can help investors determine the risk involved in holding a stock and make informed decisions about their investment portfolio. By monitoring the volatility of a stock, investors can determine the stability of the stock's price and make informed decisions about when to buy, sell, or hold the stock. Assets versus liability. In addition to the company promoter and volatility, it's important to consider the assets and liabilities of a company. Assets versus liabilities refers to the relationship between the resources a company possesses, assets, and the debts it owes, liabilities. Assets are items that a company owns that have monetary value and can be converted into cash. Examples of assets include cash, investments, real estate, and equipment. Liabilities are debts or obligations that a company owes to others. Examples of liabilities include loans, bonds, and accounts payable. The relationship between assets and liabilities is an important consideration for investors and analysts when evaluating a company's financial health. If a company has more assets than liabilities, it is generally considered to be financially healthy, as it has the resources to pay its debts. If a company has more liabilities than assets, it is considered to be financially weaker, as it may have difficulty meeting its financial obligations. When evaluating a company's financial position, it is important to consider not just the total amount of assets and liabilities, but also the types of assets and liabilities, as well as the quality of those assets and liabilities. For example, a company may have a large amount of assets, but if those assets are of low quality, they may not be able to generate enough cash flow to pay the company's debts. On the other hand, a company with a smaller amount of assets, but with high-quality assets, may be able to generate enough cash flow to pay its debts and still have money left over for other purposes. Rating. Finally, before making an investment, it's important to check the ratings of a company provided by various institutions. A rating is an evaluation or assessment of the creditworthiness, financial strength, or investment potential of a company, government, or other entity. Ratings are typically assigned by credit rating agencies, such as Moody's, Standard & Poor's, and Fitch Ratings, and are used to provide investors with an independent assessment of the risk involved in investing in a particular security. Ratings can range from very high to very low, and are expressed as letters or symbols, such as AAA, AA, A, BBB, and so on. The higher the rating, the lower the perceived risk of default or financial distress. For example, a company with a AAA rating is considered to have the highest creditworthiness, while a company with a lower rating, such as BB or CCC, is considered to be a higher credit risk. Investors use ratings to help make informed investment decisions, as they provide a quick and easy way to assess the creditworthiness and financial strength of a company or government. However, it's important to keep in mind that ratings are not a guarantee of future performance and that they are subject to change. As a result, investors should always consider multiple sources of information, including ratings, when making investment decisions. Conclusion. To summarize, before investing in the stock market, it's important to consider the company promoter, volatility, assets and liabilities, and ratings provided by institutions. By keeping these key considerations in mind, you can make informed investment decisions and increase your chances of a profitable long-term investment. Thank you for watching today's video. We hope you found this information helpful. If you have any questions or suggestions for future videos, please leave a comment below. And don't forget to like and subscribe for more investment tips and advice.